Hey guys, welcome back to this channel, and today we'll be looking at a treasury bill. You may be wondering, how do I invest my money? What's the best way to invest my money? And I'll basically be putting you through on how to use treasury bill to invest your money. All right, so basically before we go into anything, I need to let you know that treasury bill is a government instrument, short-term government instrument, and is used by federal government to raise short-term fund. All right, so basically, and it's issued on behalf of federal government by the CBN, and the tenor usually ranges from between 91 days to 364 days. All right, so that's basically what treasury bill is. And I need to also let you know that treasury bill is risk-free. What do I mean by risk-free? It simply means that the risk is almost zero. Almost zero means that you can't lose your money because, of course, it's backed by federal government, right? And all federal government securities, of course, they are sovereign. If they are sovereign, it simply means that as far as federal government continues to remain, your money must, definitely come back to you, and so you don't have the risk of losing your money. All right. So how does treasury bill work? So basically, there are two markets in treasury bill. All right. So the first market, you call it the primary market. Primary market simply means that you, the investor, you have to bid directly, from CBN. All right, and the minimum for that around by the time of this video is you must have at least a minimum of say 50 million, before you can actually bid, right? So if you can't do that, the other alternative for you is the second market, which is called the secondary market. Secondary market is more like the third party market, where you have to buy from somebody has already, purchased this treasury bill. Now, how it works is, you may be wondering, what if I don't have 50 million? Now, the option that will be available to you is simply you going to your commercial bank to go and buy treasury bill. All right, so if you're buying treasury bill, what you're doing is the commercial bank will have bidded and gotten the treasury bills from federal government or from CBN, as the case may be. And so what they will now do is they are selling it back to you at the secondary market. All right, so that's the option available to you, and you can invest as even little as maybe 100,000. And the tenor, like I said, it ranges from 91 days up to 364 days. All right, so sometimes when you get to the secondary market, right, more like the third party market, you may not really get what you want in tenor. All right, so but the good thing is, the longer you leave your money, the more interest you get, and you get, and vice versa. All right, so let's look at characteristics of treasury bill. The first characteristic is that it's risk-free. Like I mentioned before, it's risk-free, meaning that it's issued by federal government, right? So it's backed up by federal government. It means you can't lose your money. Number two is that it's a short-term instrument. What do I mean by short-term instrument? The tenor is usually between 91 days up to 364 days. All right. And the third one is that, all right, so we're talking about treasury bills. So basically, there are two markets. First one, primary market. Primary market is you buying directly from the CBN, and secondary market is you buying from somebody who has already purchased. In this case, usually it's all these finance homes, commercial banks that actually do this. They buy it, and then you go back to them as their clients or their customers, and then you buy from the banks, and those are the basic two markets, right? So basically, so the characteristics, number one characteristic is that it's risk-free. Risk-free meaning that you can't lose your money. It is issued by federal government. All right, if it's issued by federal government, it means that your money must always return back to you. Number two is that it's a short-term instrument. So usually the tenor ranges from 91 up to 364 days. All right, so, and your interest is prorated accordingly. What people don't understand is, when you go for treasury bill and you're told, oh, the interest rate is 22%, you just do a rough calculation, 22% on the face value, and then you think the entire amount will be given to you, even when you're leaving your money for 91 days. No, it doesn't work that way. So if the interest rate that is given to you on the rate board in the bank simply reflects annual, or all interest rates are quoted on per annum basis or annual basis. All right, so what it means is, if it's 22%, for me to be able to get the rate that relates to the 91 days or the 181 days that I'm fixing my money, it means that I will need to prorate that rate of 22% to be able to know the actual return that I'm going to be getting. All right. So, and again, another thing you need to know is, what if you need your money before the maturity? Now, like I said before, Treasury bill, when you go into Treasury bill investment, your interest is given to you upfront, right? So what I'm trying to say is that it's discounted. If you're investing 500,000, what is going to be taken from your account may not be up to, it won't be up to 500. All right. So let's say that they take 400,000 from your account. What that means is, tactically, the 100,000 has been given to you as interest, because when the investment matures at the end of the day, what is going to be returned into your account is the 500,000. So which means that the 100,000 has been given to you upfront, ab initio, right? So if that has been given to you and you want to now collect your money back before the maturity, what the bank will do is, one, they will prorate that 100,000 up to the time where you want your money back, and also charge you what they call penalty fee. Penalty fee means that in finance, where you're terminating a contract that is expected to give me, an expected income over a period of time, and you say, oh, halfway you're not doing again. So what it means is that, because I've planned my cash flow in that pattern, so the moment you terminate, I'm supposed to take something from you to serve as penalty. Penalty meaning that you have disrupted my cash flow plans, and so I need to charge you penalty, and that's basically how it works. So let me quickly show you how this calculation works. Okay, so let's say that the face value of this investment, let's say you have the face value is 100,000, meaning this is how much you want and you want to invest. And you're told in the bank that the yield return, or let's just use interest rate for simplicity. Interest rate, you're told currently, I think is around there, let's say 22%. 22%. All right. And then the tenor. Tenor means that how long you want to leave your money with them. Let's say you have chosen 181 days. 181 days. All right. So your return on this 100,000 will be face value, which is 100,000, multiplied by this 22%. 22%. Then remember that this is for only 181 days, and then I'll multiply by 181 days divided by how many days do I have in a year? 365 days. All right, so this is the return that the bank will be giving to me on this. So let me quickly calculate interest it will be. So since this is interest, and like I said, this interest will be given to you upfront. If it's given to you upfront, it means what they are going to be taking from you. I'm not going to be considering tax here, just for simplicity. Remember, you're supposed to pay the withholding tax on it, right? So what they'll be taking from my account will be 100,000 minus 10,910. So if I take 100,000 minus 10,910, so it means what the bank will be debiting me is 89,090. So this is what they are taking from my account, right? So what it simply means, remember, my face value is 100,000. So I've invested this 100,000, and the bank only took 89,090 from my account. What it means is that this 10,910 has been given to me upfront, all right? And so on the maturity date, at maturity, after this 181 days maturity, after this day, the bank will return 100,000 naira back into my account. All right. So if you want to collect this money before this 181 days, like I said before, what they will do is to time apportion this interest, all right, based up to the period where you want to collect your money, and then they take it back from your principal, and then whatever thing that is left, or whatever additional debit you see, will probably be the penalty charges. Thank you for watching. See you in the next video. Please like, share, and comment. Thank you.